Right now, in 2026, you may be sitting on 5 separate tax breaks, and every single one of them is set to disappear by the end of 2028 or 2029. And most people watching this video have never heard of more than 1 or 2 of them. If you're 65 or older, there's a new deduction worth up to $6,000 a year just for your age, and it's already available right now. And it goes away for good in a few years unless Congress steps in and extends it, which it may or may not do. And that's just the first one. There are 4 more, and one of them, the one we're saving for the end of this video, is worth more to some retirees than all the others put together. And almost nobody claims it because almost nobody knows it exists. So stay with me, because by the end of this video, you'll know exactly what these 5 breaks are, exactly when they expire, and exactly what to do before that clock runs out. Hi, I'm Walter Sinclair, and if you're new here, welcome. And if you've been here before, thank you for coming back. Before we get into it, I want to be upfront with you the way I always am. I'm not a financial advisor, I'm not an accountant, and I don't work for the IRS or the Social Security Administration, and I'm not trying to sell you anything today. What I do is spend my week going through IRS updates, tax filing guidance, and the actual text of new laws, so that you don't have to sit down and read an 870-page bill just to figure out what changed for you. This particular law is called the One Big Beautiful Bill Act, and it was signed in the summer of 2025, and it touched almost every part of the tax code. And most of the coverage you've seen has focused on business provisions or big national numbers, and almost none of it has focused on what it actually means for a retiree sitting down to do their own taxes. So here's what we're covering today, in order. First, the new deduction just for being 65 or older, and how much it's really worth. Second, a change to how much you can deduct for state and local taxes, if you itemize. Third, a brand new deduction for tip income, which matters more than you'd think for retirees who still pick up part-time work. Fourth, a similar new deduction for overtime pay. And fifth, saved for the end, a deduction almost nobody claims, tied to something as ordinary as a car payment. Every single one of these 5 breaks has a real expiration date attached to it, and we'll walk through every one of those dates so you know exactly how much time you have. If this is useful to you, I'd ask one small favor. Consider subscribing. Not for my sake, but because I put out one of these videos every week, walking through exactly this kind of update. And if a rule changes on any of these 5 breaks, you'll hear about it here before you hear about it anywhere else. Now let's get into the details. Let's start with the one most people have at least half heard about, the new senior deduction. If you're 65 or older, you can now claim an extra $6,000 off your taxable income. And if you're married, and both you and your spouse are 65 or older and you file jointly, that number doubles to $12,000. And here's the part most people miss. This is on top of the extra standard deduction that's already existed for years for people 65 and older. So you're not choosing between the two, you're stacking them. This new $6,000 break is only available for tax years 2025 through 2028, so it's already running, and it disappears after the 2028 tax year unless a future Congress decides to renew it. There is one catch worth knowing. It starts to phase out once your modified adjusted gross income goes above $75,000 for a single filer or $150,000 for a married couple filing jointly. And above certain income levels, it phases out completely. So if your income is well under those numbers, this is essentially free money sitting on the table. And if you haven't checked whether your tax preparer applied it, that's worth a phone call. Second, let's talk about the state and local tax deduction, usually called the SALT deduction. For years, if you itemized your taxes instead of taking the standard deduction, you could only deduct up to $10,000 in state and local taxes, no matter how much you actually paid. That cap has now been raised, temporarily, to $40,000, and it applies from 2025 through 2029, with the cap increasing slightly each year during that stretch. Now, this one mostly helps people who itemize, and it helps the most if you live in a state with higher property taxes or higher state income taxes. So, if you're in a lower tax state and you take the standard deduction anyway, this particular change may not move the needle much for you. But if you do itemize, and you've been frustrated for years watching that $10,000 cap eat into your deduction, this is real relief, and it's worth asking your preparer to check. One more detail. If your income is above $500,000, this higher cap starts to shrink. So this break is really aimed at middle and upper middle income retirees, not the very top. Third, there's a brand new deduction for tip income, and I want to spend a minute on this because a lot of people assume this doesn't apply to them at all, and for some of you, it might. If you're retired but still picking up part-time work, maybe at a restaurant, maybe driving for a rideshare service, maybe doing seasonal retail work over the holidays, and some of your income comes in the form of tips, this new law lets you deduct a portion of that tip income directly, separate from your regular wages. This deduction also runs from 2025 through 2028, the same window as the senior deduction, so mark that date down because these two temporary breaks expire together. Now here's something worth pausing on. This doesn't mean tips are invisible to the tax system, and it doesn't mean they're exempt from Social Security or Medicare payroll withholding. It simply means you get to deduct a portion of that income when you calculate your federal income tax. So don't assume this changes anything about how your paycheck itself is taxed in the moment. It changes what you owe when you file. And one more thing worth saying clearly about all three of these breaks so far. None of them require you to fill out some special application, and none of them require you to call the IRS or wait on hold for an hour, because these are deductions you claim directly on your regular tax return, the same one you file every year, which means the only real risk here isn't paperwork, it's simply not knowing to ask for them in the first place. So that's three breaks down: the senior deduction, the SALT cap increase, and the tips deduction. If you already knew about one of these, there's a good chance you were missing at least one of the other two, and we're only halfway through the list. Let me tell you about Harold. Harold is 71 years old. He spent most of his working life as a mechanic outside Columbus, Ohio, and after he retired, he kept doing a little seasonal work at an auto shop near his house, partly for the extra money and partly because he likes staying busy. For years, Harold just handed his paperwork to the same tax preparer he'd used for over a decade, and he assumed that was enough. And he never asked any follow-up questions about what had changed in the law. Because why would he? That's what he was paying someone else to know. Last tax season, Harold's granddaughter, who was helping him organize some paperwork, noticed a line on his return for the new senior deduction and asked him if he knew what it was, and Harold didn't. So together they went back and confirmed his preparer had applied it correctly, which knocked $6,000 off his taxable income right there. But then they also realized that some of the extra cash Harold had been earning at the shop, small tips customers gave him for staying late on a repair, hadn't been separated out to claim the new tips deduction because Harold had never mentioned it, and his preparer had no way of knowing to ask. Once they sorted it out, between the senior deduction and properly claiming the tip income deduction, Harold's taxable income dropped by several $1,000s more than it would have otherwise. And that's real money that stayed in his pocket instead of going to the IRS. But here's what mattered more to Harold than the number itself. He told his granddaughter afterward that it wasn't really about the dollar amount. It was about not wanting to feel like he had to ask his kids for help covering a bill because he'd missed something he was entitled to. That's the stakes here, for Harold and for a lot of people watching this. It's not just about maximizing a refund. It's about keeping the independence you've worked your whole life for, and not leaving money on the table out of not knowing to ask. Let's pick back up with break number 4, the new deduction for overtime pay. Just like the tips deduction, this is a brand new provision under the same law, and it also runs from 2025 through 2028. So if you clocked overtime hours, whether you're semi-retired and working extra shifts, or you're the spouse of someone still working overtime and filing jointly, this deduction lets you deduct a portion of that overtime pay separately when you file. And I want to clear up a misunderstanding I've seen a lot of people fall into with both this deduction and the tips deduction we just covered. This is not the same as saying that income is completely tax-free in every sense. It's a federal income tax deduction with its own limits and its own rules. So your overtime and tip income still shows up on your paycheck and still gets reported the way it always has. This deduction simply reduces what you owe at tax time. It's a real benefit, but it's not a blank exemption, and understanding that difference will save you from a surprise later. So that's 4 breaks covered: the senior deduction, the SALT cap increase, the tips deduction, and the overtime deduction. Every one of them is real. Every one of them is already in effect. And every one of them has an expiration date attached, either the end of 2028 or the end of 2029, depending on which break we're talking about. But I said at the very beginning of this video that there was a 5th break, and that it might be worth more to some of you than all 4 of the others combined. And I meant that. It's tied to something almost every retiree deals with at some point. Something as ordinary as a car payment, and almost nobody claims it because almost nobody realizes it's there. We're going to walk through exactly how it works in a few minutes, but first, I want to take a quick detour because I know some of you are already skeptical, and I want to address that head on. I know what some of you are thinking right now. If these breaks are real, wouldn't my accountant have already told me? And that's a fair question, so let me answer it honestly. This law runs 870 pages long, and it touches business taxes, estate taxes, charitable giving rules, student loan programs, and a dozen other areas that have nothing to do with retirees at all. A good tax preparer is going to catch the big, obvious items, like the senior deduction, because that one's been in the headlines. But the smaller, more specific provisions, like the tips deduction, the overtime deduction, or the one we're about to cover, those are easy to miss unless you specifically bring them up, because your preparer isn't a mind reader, and they're relying on you to tell them about tip income or overtime hours or a new car loan, not the other way around. This isn't some hidden secret being kept from you, and it isn't a scam. It's just what happens when a law this big passes all at once. And a lot of people, including some tax professionals, are still catching up on all the details. I'm not here to sell you anything today, and I never will be. I'm just someone who reads through these updates every week so I can bring them to you in plain language and point you toward the real source, which for anything tax-related is always irs.gov. Before we get to that 5th break, I want to offer you something. I've put together a simple, one-page checklist covering all 5 of these tax breaks, with the expiration year for each one and the basic qualification rules, so you can print it out, bring it to your tax preparer, or just keep it on your fridge as a reminder. It's free, there's no catch, and the link is right there. Think of it as a cheat sheet for this exact video, so you don't have to try to remember every number I just walked through. Now, let's get to the big one. Here it is. The 5th tax break. The one I told you at the start might be worth more than all the others combined for the right person, is a brand new deduction on the interest you pay for a car loan, specifically for new vehicles that are assembled here in the United States. This is a genuinely new idea in the tax code. There's never been anything quite like it before, and that's exactly why so few people know it exists. Here's how it works in practice. Let's say you financed a new vehicle in 2025 or 2026 that was assembled in the US, and over the course of the year, you paid a meaningful amount in interest on that loan, the same way you would with a mortgage. Under this new provision, you can deduct that interest directly, separate from your other deductions, and separate from whether you itemize or take the standard deduction. For a retiree who financed a newer vehicle, especially one bought in the last year or two with a larger loan balance and a higher interest rate, that deduction can add up to a real, meaningful reduction in what you owe, sometimes more than any of the other 4 breaks we've covered today, simply because vehicle interest, especially in the last couple of years, has not been cheap. Just like the tips and overtime deductions, this one runs from 2025 through 2028. So if you're planning to finance a new vehicle and you want to take advantage of this, the window to do it is now, not 5 years from now. One detail worth double-checking before you count on this one. It applies specifically to loans on new vehicles assembled in the United States, not used vehicles, and not vehicles assembled elsewhere. So if you're shopping for a car soon and this deduction matters to you, It's worth asking the dealer directly where final assembly took place, because that detail alone decides whether this deduction applies to your loan at all. And remember what I told you at the very beginning of this video, that one item on this list would be worth more than the rest combined for the right retiree. For someone who's currently paying off a loan on a new US-assembled vehicle, this is that item. And it's the one most likely to be sitting there completely unclaimed on your return right now. Let's bring this all together with a quick, plain checklist of everything we covered today. Number 1. If you're 65 or older, confirm you're claiming the new $6,000 senior deduction, $12,000 if you're married filing jointly and both of you qualify. And remember, it's available through the 2028 tax year. Number 2. If you itemize your deductions, ask your preparer whether you're getting the full benefit of the higher $40,000 SALT cap, available through 2029. Number 3. If you earned any tip income this year, even from part-time or seasonal work, make sure that income is separated out so you can claim the new tips deduction, available through 2028. Number 4. If you or your spouse earned overtime pay, confirm that's being deducted separately as well. Same 2028 expiration. And number 5, the big one. If you financed a new US-assembled vehicle in 2025 or later, ask specifically about the new auto loan interest deduction, because this is the one most likely to be missed if you don't bring it up yourself. Every single one of these has a real deadline attached, so don't wait until the last year of the window to check. If you know a retiree who does their own taxes, or even one who uses a preparer but doesn't always ask the right questions, send them this video, because the difference between claiming these 5 breaks and missing them could be hundreds or even thousands of dollars they're entitled to and simply don't know about. I'd also love to hear from you in the comments. Which of these 5 surprised you the most? For a lot of people, it's the car loan interest deduction, since nobody expects that one. Next week, we're going to walk through a related topic, one Medicare cost that's projected to rise in 2027, and exactly how much of your next Social Security raise it could quietly eat into, so keep an eye out for that. Until then, this is Walter Sinclair, reminding you, read the fine print, ask the follow-up question, and don't leave money on the table that's already yours. I'll see you in the next one.